the world's most powerful money managers, just told us exactly what they're doing with their reserves. Not analysts, not commentators, the reserve managers themselves. The people who safeguard entire nations' wealth. And what they said should stop every investor in their tracks. Because while the financial media was screaming that gold was finished, that the trade was over, sell now, move on, these institutions did the exact opposite. They actually bought more gold, and then they moved it. I'm Nicholas Ward from Gold Bullion Partners, and in the next 8 minutes, I'm going to show you what they know, why the recent price dip is almost certainly a gift, and why the question is no longer whether you should own gold, it's whether the gold that you do own is actually yours. So let's start with the correction, because if you've been watching the gold price lately, it's stubborn. Gold's dropped around 25% from its highs, and every headline has called it a crash. But here's a framework that will change how you read those headlines forever. There are two completely different types of gold buyers. The first type I call structural buyers, so central banks, sovereign wealth funds, institutions whose entire mandate is to protect long-term wealth. Now, they don't chase price. They buy based on policy, on risk frameworks, on decades of institutional thinking. Rain or shine, high prices or low, they keep accumulating. Now, the second type are momentum buyers, hedge funds, retail traders, anyone who piled in because gold was going up and they didn't want to miss out. They're not here for the fundamentals, they're here for the move. And the moment the move reverses, they're gone. What happened in this correction? Well, it's those momentum buyers that left. The speculators liquidated, the price snapped back. But the structural buyers, well, they never stopped for a single day. Think of it like this. There's a house worth $500,000 in a genuinely great location. Flippers push it to $700,000 on pure momentum. Then the flippers leave and the price drops back. Did the house get any worse? Well, no. The serious long-term buyer who understands the neighborhood, well, he's still there, he's still buying. And that's precisely what's happened with gold. So next time you see a scary headline, ask yourself one question. Did the structural buyers stop? Because the answer right now is a definitive no. Now, the World Gold Council just published their annual central bank survey last month. 76 central bank respondents. The most comprehensive read on the official sector gold strategy available. And here are the numbers that really do matter. Central banks have now bought over 1,000 tons of gold per year for 4 consecutive years. 2022, 1,082 tons, the highest since 1969. 2023, 1,049 tons. 2024, 1,045 tons. And that's double the pace of the previous decade. And this is not a post-pandemic anomaly. It's sustained, deliberate, strategic, and it's a shift. And before 2010, well, these same institutions were selling gold, treating it as a relic of a bygone era. And that consensus really did hold for decades. And then it reversed completely. And the pace has surprised, well, even the institutions themselves. Now, 89% of respondents expect global central bank gold reserves to increase over the next 12 months. And a record 45% expect their own institutions' reserves to rise. Just 1% expect a reduction. Now, that is not a market divided on gold by any means. That is near unanimous conviction at the highest institutional level on earth. And here is the critical insight that most investors miss. These institutions have been buying through all-time highs. Price was not a deterrent. When you're managing a sovereign reserve portfolio, the question you're asking isn't whether gold has gone up too fast. The question is, what does this asset do when everything else breaks down? For thousands of years, gold has been that answer. So why are they buying? The survey asked them directly, and three reasons dominated: performance during crisis, long-term storage value, and this one is pointed and very, very important: no default risk. And in a world where the primary alternative reserve asset, US Treasury bonds, is backed by a government carrying 28 trillion in debt, well, it's almost 30 trillion actually, and climbing, no default risk is a deliberate, loaded statement. These are diplomatic institutions. They will not publicly question US creditworthiness, but in an anonymous survey, that signal's pretty clear. It's unambiguous, really. 74% of central banks expect the dollar's share of global reserves to fall within 5 years. That's not a fringe view. That is the majority position among institutions that collectively hold trillions in reserve assets. The dollar retreats, gold advances. That is the structural story running through every page of this report. Now, here's the part of this story that almost nobody is covering, and in my view, it's the most important signal of all. Central banks are not just buying gold, they're physically moving it. In the past 12 months alone, 9% of central banks increased their domestic gold storage held within their own vaults. And that's up from 5% the year before. Another 10% diversified their overseas vaulting locations, up from just 2% the year before. That is a near doubling in the proportion of institutions actively relocating sovereign gold in a single year. Sovereign decisions are never made lightly. To move sovereign gold between jurisdictions requires diplomatic logistics, security infrastructure, and complex legal agreements. When institutions go to that effort, it tells you that physical control has become a strategic priority in a way that it simply wasn't before. Why now? Because of a movement that every central bank had watched very carefully. When Russia invaded Ukraine, the Western allies froze 300 billion of Russian central bank reserves, just locked it. Russia could no longer access its own assets. Every reserve manager in the world had a meeting the next morning, and the question on the table was the same in every room. If they can freeze Russia's assets, can they freeze mine? The answer was obvious, and the response has been a quiet, accelerating repatriation of gold to home soil, because the one thing nobody can freeze is a gold bar sitting in a vault inside your own borders. This is not an investment return calculation. This is about sovereignty, national security, and it raises a question that every private investor should be asking themselves right now. If you hold a gold ETF, you hold a financial instrument. You do not hold gold. If you hold an unallocated account, you are an unsecured creditor of a bank. If the conditions driving this central bank behavior get worse, not better, that distinction becomes the only thing that matters. The world's most sophisticated risk managers have looked at this same question and concluded that physical, allocated, segregated gold held in a stable jurisdiction is worth every bit of the logistical cost. Now let me put this all together. We are not in a normal market cycle. We are in a structural realignment of the global monetary order. The institutions that anchor that order are simultaneously the institutions most actively building exposure to the one asset that sits outside of it. 74% expect the dollar to lose ground. 89% expect gold holdings to increase. The pace of physical relocation is accelerating, and geopolitical risk has, for the first time ever, overtaken inflation as the primary driver of these decisions. The emerging markets as well, India, Brazil, Poland, China, they're all leading the charge. Half of all emerging market central banks plan to buy more gold. These are the fastest growing economies in the world. And they're all reaching the same conclusion. They cannot afford to depend entirely on a financial system they don't fully control. One central banker in the survey, they put it pretty plainly. They said, we want to diversify away from the dollar, but there aren't many alternatives, so we're buying the best one that's available. That alternative is gold. And it's been money for 5,000 years for exactly that reason. No counterparty risk, no default risk, no government can print more of it, no sanctions regime can freeze it if you hold it properly. So the dip was noise. The structure has never been any stronger. The smartest, most conservative, most thoroughly resourced money managers on the planet are not just buying gold, they're going to extraordinary lengths to make sure they physically hold it. At Gold Bullion Partners, that is exactly what we help our clients do. Physical, allocated gold, properly held, properly yours. If you want to understand what that means for your own position, the link's below. I'm Nicholas Ward. Thanks very much for watching.